Hi, and today we're going to take a look at what's been happening in Venezuela, and more pointedly, whether it really changes the outlook for oil prices moving forwards. Well, as I'm sure you're aware, in early January, the United States launched a large-scale military operation against Venezuela and its president. The narrative seemed to be relatively straightforward. Regime change could unlock Venezuela's massive oil reserves and bring a wave of new supply to the global market. But does that assumption actually hold up? Well, firstly, let's have a look at why Venezuela. Well, Venezuela was once one of the largest oil suppliers to the United States. That relationship, however, collapsed after the nationalization of US energy assets under the government of Hugo Chavez back in 2007. Since then, production has fallen sharply, despite Venezuela holding one of the world's largest reserve bases. So the big question is, can Venezuela now drive oil prices significantly lower? Well, on paper and in black and white, Venezuela does appear to look like a game changer. It holds around 17% of global oil reserves, yet produces less than 1% of global supply at the moment. So the idea being, remove political constraints and output should rise. Well, that's at least in theory, but in reality, the barriers are structural and severe. Now, firstly, Venezuela's oil infrastructure has deteriorated massively after years of underinvestment, mismanagement, and of course sanctions. And most of the reserves we talk about are in the Orinoco Belt. They are extra heavy crude. Now, that is very, very expensive to process. Analysts at the moment estimate restoring production to peak levels would require in the region of $10 billion a year for over a decade. Secondly, Venezuela has a history of seizing foreign assets, including ExxonMobil and ConocoPhillips back in 2007, as we've mentioned. Now, billions in arbitration claims remain unpaid. Investors need enforceable contracts and long-term legal protection to see it as an attractive investment. Currently, even large US companies such as ExxonMobil, with their history and experience in the country, claim that Venezuela is pretty much uninvestable. A third, oil is not scarce. Global production exceeds 100 million barrels a day, and lower risk regions such as Brazil, for example, Guyana, and offshore Africa offer faster payback and far lower geopolitical risk than Venezuela does currently. Now, if we take all of that together, these barriers mean Venezuela is unlikely to deliver a rapid supply shock. Now, according to analysts, even under the most optimistic of scenarios, production may grow by only 250,000 barrels per day at some point in the future. Now, that's against a backdrop of 100 million barrels per day produced globally. So you can see that it's not going to make a significant dent. And most forecasts for the price of Brent crude are in the region of 55 to 65 US dollars per barrel for the whole of 2026. Of course, short-term spikes are expected as news about Venezuelan oil will impact market sentiment. Still, oil prices will remain driven by broader global supply and demand dynamics and geopolitical risks elsewhere, not by a sudden flood, it would appear, of Venezuelan oil. But as usual, don't forget your risk management tools and stay updated with FX Open. Bye for now.